What's up, founders? My name is John Ladaga. I'm the co-founder of a company called Sturppy. We help founders. We've helped over 4,500 founders build financial models to obtain funding from all the way from pre-seed all the way to Series A and the millions of dollars. Today, we're going to go over building out a seat-based SaaS financial model. So we're going to talk about what that looks like, how to build it, and yeah. So let's dive in. Today we're going to be looking at an example company called Slacker. Might sound familiar to another big SaaS company, maybe, don't know. But Slacker is a new startup. They're pre-seed. Slacker's a SaaS company, right? Software as a service, and it's team collaboration software. So you can log into Slacker, you can chat your teammates, video call them, share documents, all that kind of stuff today, made for the remote workforce. So they have what's called a seat-based pricing strategy. So a lot of different strategies in the world of SaaS for how you're going to monetize your users. So you could have something like a flat rate, which says, we're going to monetize based on just set tiers. But you could also have seat-based. So seat-based is basically we're going to charge per seat a license fee. So if you have, let's say you have a seat price of $5 and you have one user at $5 a month. If you bring on five users to that same account, now they're paying $25 a month. So that's seat-based pricing. Let's kind of dive into some of the details here. So there are three main components in building out a financial model, regardless if you're building on Sturppy or you're building something in Excel yourself. So the first is going to be our revenue streams. So this is where we're going to model out, how we're actually monetizing those users. It's going to include things like your conversion rates, right? So from like a free trial to a paying user. It's also going to include your different pricing assumptions and the mechanics there. The second thing in a financial model is going to be your acquisition strategy. So this is actually modeling out how are you acquiring new leads to then become free trial, if you have a free trial, or paying users eventually. So that's going to include things like in this example, SEO, so search engine optimization. Slacker, this company, has a blog where they rank for keywords on Google. So if you're searching collaboration software, you might come across one of their blog articles. Click on that blog, and then hopefully they can convert you into being a customer. Acquisition strategy is also going to include things like paid social ads. So if you're doing advertising on LinkedIn or on Instagram or Facebook, that's a way of acquiring new customers. Another thing that can be considered an acquisition channel, it would be cold outreach. So maybe if you have a higher dollar product or you're trying to sell to enterprises or existing businesses, you might be doing some cold outreach, sending out emails based on an email list, and then getting a response rate there. So acquisition, second part of the model. Third part of the model is going to be your expenses. Now, expenses get broken down into some different categories, right? So there's kind of your cost of goods sold, or COGS, which is going to be things like any expense that is needed to deliver to the end product. So for a SaaS company, it's a little bit different than, say, an e-commerce company. So SaaS, it might be your hosting costs, your website costs. It could even be your customer support. If that's considered a critical thing to your business to deliver the service, then it would be considered a COG. If you're looking at like an e-commerce company or something that sells physical goods, your cost of goods sold are going to be kind of the raw materials. For example, if you're e-commerce selling t-shirts, that's going to be, the raw materials to create those t-shirts. And then you're also going to have SG&A expenses. SG&A expenses stands for selling, general, and administrative. And these are just expenses associated with running the business. So this is where your payroll for your employees is going to come in. This is also going to be if you have like rent for an office space. If you have just internal software that you use to collaborate with your team, like Microsoft 365, things like that. All that's going to be considered SG&A. So let's dive in. I'll show you just how easy it is. We'll kind of run through building the model from scratch. And so first thing I'm going to do, I'm already in Sturppy, so I'm going to click a new project. And so within Sturppy, we actually build a whole bunch of custom templates to try, to kind of speed up the model building process. But You can also build from scratch. So just because you don't see a template here that fits your exact business, you can take one of these templates and modify it, or just completely build from scratch. So for this case, we're looking at seat-based pricing. So I'm just going to do a search here, and I have two options for seat-based pricing. One that includes no free trial, and one that includes a free trial. So in this particular example, Slacker has like a 30-day free trial. So we're going to choose the free trial version. There's just kind of a little overview of what this model is, some screenshots of kind of some of the KPIs, assumptions that are baked into the model. So we're going to click use this template. We're going to give this template a name. I'm going to name it Slacker Financial Projections. Sturppy supports all sorts of different currencies here. So we're going to stick to dollars, but you can use, pounds, you can use euros, whatever currency you would like to model in. You can do that. So I'll click create here. We'll create the template model here. And now we're kind of set up with the basics. So out of the box, we have this nice dashboard with some key KPIs, revenues versus expenses, burn rate, expense breakdown, subscribers, all that stuff that we would like to see. Total seats, because we are a seat-based company, we want to be able to see that. So now all we have to do is kind of go into Sturppy and kind of change some of these assumptions to kind of match what our business is, our own business strategy. So we can start off by looking at acquisition strategies. So I'm going to come into Sturppy, I'm going to click the acquisitions tab, and we've already pre-populated some paid social ads, SEO, and word of mouth. But if you remember from our design brief, we have SEO, paid social, and then we actually also have cold outreach. So let's start by editing the SEO assumptions and just look at what that means. So I'm going to click SEO. I'll just pull it up to the top just so it's in the same order. Click SEO here, and out of the box, we have this nice graph that shows kind of the number of leads that we're generating. But in order to kind of access the inputs, the driver assumptions behind this, we open this drawer here. And so there's two things that go into modeling SEO. First, there's going to be the number of keywords that you're generating on a monthly basis. So if you don't know what I'm talking about, you can Google some more about SEO, but basically every business that is a public business connected to Google, you can use Google Search Console. So if you just Google Search Console, this one right here, Google Search Console, that's going to pull up and set up your ability to see, how many keywords you're actually ranking for. So when I type something like collaboration software, does my blog article actually, show up within this list here? So that's going to be your keywords. So for this business, maybe they don't have this many, they're not ranking that highly yet. They're just starting off. So what we can say is maybe in the beginning they only have, let's say they're just starting out. They're a little new. So let's say maybe they have 20,000 keywords. But then this is going to grow. So as this channel grows, we wanted to add kind of a modifier here. And we could say, maybe they're going to be aggressive with their SEO. So it's going to grow 5% month over month. We could make this quarters, years, but we'll just leave it at month for now. And we'll click X here. The other important thing that we have is a CTR. So this is your click-through rate. And so this means each month we're going to have we're going to show up in 20,000 results on Google, and then 3% of people that actually see those results are going to click onto our blog. And so that's kind of how we're modeling this out here. That's that click-through rate, because you can think about it, even if you're showing up 20,000 times on a Google search, a lot of that's going to be, you're going to be on like the 50th page. And when's the last time you clicked on the 50th page of a Google search and clicked a website? Probably not very often. So 3% is kind of a solid baseline. And we could change this, and maybe in the beginning they're going to be 1%. And then this is going to get, improved by 10%. And then we can actually set like an upper threshold and say, we never want to go above kind of 3% there. So we can see that. We can see that kind of scaling. So in January, both these are growing over time. And then eventually in January of 2024, we're seeing that we kind of hit that 3%. And that's seen, by looking at this graph. We can see we're generating now, 200 leads in kind of month one of the model. And then further down at the end of this model, we're generating much more, 3,000 plus leads. So that's setting up kind of SEO there. Next thing we could do is look at the paid social ads. So paid social ads is going to get broken down into two different kind of components here. In paid advertising, you're always going to set a daily campaign budget. So out of the box, we have a daily campaign budget of $25 a day. And then we have a target CPC, which is your cost per click. So maybe we want to increase this. So we'll say $25 a day is great, but we're actually going to grow this budget by 10% every quarter. And we're going to invest a little bit more. So we'll leave that there. And now we can see, we're spending $25 a day in January, $25 a day in February, so on and so forth as we increase this budget. Cost per click, we'll leave at $2. So we'll just leave that there at $2. And now we can see this acquisition channel is growing over time. So in the beginning, we have 375 leads coming from this channel. By the end, we have over 1,000 leads coming from this particular acquisition channel. Last thing we need to do, we don't have word of mouth in this particular case, so I can just come in here. If I want to delete this, I can. So all I do is come into word of mouth, click delete, and then click yes, I want to delete that. It's removed. And now we want to add in cold outreach. So all I have to do to add a new acquisition channel is click this add new channel button, give it a name. Let's just call it cold email outreach. Boom. And then now we have some pre-templates to kind of select here. So lots of different things to choose from. For this example, we're going to choose cold outreach. And then we're just going to simply follow these prompts of kind of what the inputs are for this particular acquisition channel. So here we'll say number of cold contacts per month. Maybe, we're contacting 50 companies a month, and then only about 7% of them are going to actually respond to our particular, to our cold emails. So we'll click complete here. And now we can see those leads. And it's not growing because we didn't grow the number of cold contacts per month. So we could grow this if we want with kind of a modifier here, but for this example, we'll just keep it as is, say that we're generating 4 new leads from this cold email outreach. And actually we can rename this. We could rename it Enterprise, because we're only going to be cold contacting kind of for this Enterprise Pro plan right here. So we'll come back into Sturppy now that we've modeled out our acquisition, the first part of our building a financial model. We're actually going to jump into revenues. So out of the box, we already, because we selected this template, we have seat-based subscriptions already kind of out of the box. And this is where we can actually attach our acquisition channels. So we're generating those leads in acquisition, and then those leads come into our revenue streams. And so this first one out of the box, maybe we call this seat-based pricing. If we look at our design brief, we have 2 plans. So we have like this basic plan, and we also have an enterprise plan. So let's just set this one up as basic plan. Basic plan. We'll rename it, and then we'll open the assumptions drawer again. So if we look at our design brief, we do have some 100 existing customers. So we can come in here to the existing customers and put 100 there. And now we can see those existing customers are being accounted for. And then we have a couple of different kind of assumptions that we also have to add in here. So we have to have a free trial sign-up conversion rate. So of those leads that we're generating from those acquisition channels, SEO and paid social, what percentage of folks that are actually on your website are going to sign up for a free trial? Here we've put 7%. So we'll just leave it at that. We also then have a second conversion rate of free trial to paid user conversions. and we have that at 35%. So if we have 100 leads that come in the door, 7% of them are going to sign up for a free trial. So that's going to be 7. And then 35% of 7 is going to be a smaller amount. I'm not good at public math, but that's how we're going to kind of convert. And then also in any sort of subscription business, you have to account for your monthly churn. So monthly churn is going to be the number of customers that we're losing each month. So maybe in the beginning, our churn is going to be high. We're just starting out. We're not really good at retaining those customers. So we can say it's 10%. And then we're going to reduce this and say maybe we're going to reduce this by 10% every month. And we're never going to go below 5%. And so we can see here that our churn starts kind of high and then improves to 5% in August of 2023. A couple of other kind of general assumptions that we have to make for this particular revenue stream. Are there any one-time fees associated with setting up, an account? We'll say no. And then also an average number of seats per account. So folks that are signing up for the basic plan, this is collaboration software. They're going to invite their teammates. So we have to come up with an assumption around the number of seats that are going to be basically signed up for the basic plan. So we have a value of 5 here. Maybe that's a little high for us, and we say it's going to be actually 3. So this is going to be smaller teams, only 3 folks actually signing up. And then we have a price of $5 a month. So we'll change this average monthly price per seat of $5 to $5. So basically what this is doing is saying each customer that comes in, they're going to convert, eventually becoming a paying customer. They're going to bring 2 of their colleagues with them. So there's going to be 3 total seats. And each one of those seats is going to be $5. So each new customer basically is $15 a month or $15 MRR. And so out of the box, we get these nice graphs. We have this yellow line with our total concurrent subscribers. And we can see here our new paying subscribers that we're bringing in, and then also the churn subscribers over time. We also have the total revenue from this acquisition channel. We have the number of total seats that we're actually bringing in, and we also kind of have this step to show how many new free trials we're generating each month, and then new paying subscribers that are coming out of those free trials. So we've set that up, but if we look at our kind of design brief here, we also have this Enterprise Pro plan that's set up a little bit differently. So they only have 5 existing customers, and it's $30 a month for this one. So what we'll do, we could add a new revenue stream, and we could kind of go and click a new revenue stream here. The other way that we could do this is just to clone this one. So what I'm going to do is come into the basic plan, click the clone button, and now we have an exact copy of this revenue stream. So I can come in here and I'll change this name to Enterprise Plan. Boom, boom, boom. And then we can update these assumptions. So they only have 10 existing customers here, so we'll change that to 10. Maybe we leave the free trial and kind of conversion rates the same. But maybe these have, a much larger amount of customers or seats associated with them. So maybe this is more like 100 seats because these are enterprises, right? So it's going to be a large amount of folks. And then we have to update the average monthly price per seat to our $30. And so now we get a similar graph here. Our total revenue is going to be much higher. We can see now we're in the hundreds of thousands of dollars, millions of dollars by the end of this. Of showing this kind of grow over time. And so now we're kind of out masking, the basic plan here because this enterprise plan is so aggressive, but we can see kind of a better view, and we can actually say, let's remove that, the enterprise plan and just look at the seat base. So in June of 2024, we're projecting that we're going to have a total, you can see the total there, of $1.2 million in revenue. 7,000 of that is coming from this basic plan, which is not super great, but that's okay. The other thing that we need to do is kind of associate the acquisition channels. So for this one, we actually do want to include that cold email outreach And maybe for, SEO and paid social ads, it's not all that feasible that we're going to get that much traffic from those channels for the enterprise. So what I can do is kind of open up the acquisition channels here and say, maybe only maybe 10% of traffic is interested in from SEO is interested in the enterprise plan. Same with cold email outreach. So we'll just reduce those so that we're not counting those acquisition channels twice. We'll click close here, and that's going to drastically reduce our revenue for this because it was a little aggressive. It still is, but that's okay. And that's kind of setting up their revenue streams. So out of the box, we kind of have that nice graph broken down by revenue streams. Everything on the home page automatically gets adjusted and updated. And then last but not least, we got to set up our expenses. So just looking at our expenses, we've got a couple. We have COGS. We're basically saying it's going to cost us $20 a month for our website, and then it's going to cost us 25 cents per month per paying user in storage costs. So what we're going to do is come into COGS, open up the editor here. I'll just move my face out of the way. And we pre-populated some of these. So we can reuse this one website, and we'll just say it's $20 a month. And then we'll delete kind of our Stripe processing fees. We'll delete our front-end hosting. And maybe we'll rename this one to storage costs. Let's just call it storage costs. And that's going to be 25 cents times the number of total customers that we have, right? And the nice thing about Sturppy is that it's automatically going to scale that expense, right? So as you add new customers to the platform, we're seeing that those storage costs are going to increase. So a big mistake I see oftentimes in Excel models is they forget that some of these expenses are actually going to scale based on how the business scales. And so now we've covered our COGS, we can come back into expenses and we can look at SG&A. SG&A gets broken into two sections. We have kind of our payroll, employee hiring, and we also have general and administrative. So let's first go into general administrative, open this bad boy up, and just look back at our design brief. We have Microsoft 365, we have some legal fees, finance and accounting, and then some one-time startup fees. So I'm just going to delete all of these for the most part because we just don't need them from the template. We do have Microsoft 365, although we're saying that it is going to be $50 per employee. So I'm going to change this to 50. And then the nice thing, just like we scaled those COGS based on customers, we can actually scale this based on the number of our employees. Super helpful to kind of scale your expenses in that way. I'm going to add 3 more rows for our other 3 expenses. Our first one is legal fees. And legal fees are costing us $1,000 a quarter. Those expensive lawyers. I'm going to choose this, and then instead of monthly, I'm going to put quarterly. And now we can see quarterly expenses for legal fees coming right in that way. The other thing we have is accounting and bookkeeping. And that is $400 a month. Boom, keep it at month. And then we had these one-time startup fees of $2,000. And we can change the period just to one time. We could add a start date to this too. By default, it's just going to start in kind of month 1 of the model. We'll just leave it at that. So we can see that month 1 is going to be expensive because we kind of have these startup fees there. You can also see we've also pulled in, because we have those paid acquisition channels, we've pulled in our paid social ads right here. So those automatically get pulled in. If I just kind of get rid of some of these, we can just see that we have those paid social ads already included here. So no need to add them twice. They automatically get pulled in from acquisitions. Last thing we have to do in the model is set up our employee team and hiring. And for that, we have 2 co-founders paying themselves that nice ramen salary of $2K a month. And then we have a junior dev at $5K a month, and then a customer support rep at $2K a month in salary. So we already have 2 co-founders here. We can give them a name if we want, Bob, Sally. And then if we want to, we can actually grow salary based on the same kind of assumptions and hiring rules. So we can say, in this example, we'd say maybe we want to increase their salary every year. So we've set it to 2,000, and we're going to grow this salary by 100% year over year, never going above $12,000. So we can actually see that in month 1, we're paying ourselves $2K. Year 2, we're paying $4K. Year 3, $8K. You guys understand. As far as our dev team, we can delete out our designer. We don't have a designer. We don't have a senior dev. We just have this junior dev at $5,000 a month. Now the count, we could say, is 1 because we're only hiring 1 role for that. If we had 2 devs, we could put 2 there. We don't have sales and marketing, so we can actually delete this department if we want. And then we do have customer support, and we have that customer support at $2,000 a month. And now here's where we can also add some hiring rules. So right now we're just saying we just have 1 customer support rep. But as the business scales, maybe we want to add a hiring rule to say, let's say every 300 new customers we want to add and hire for this position. So we can see in this count here, we have 0, no one in this role. But then in September, we make our first hire. And then in June 2024, we make our second hire, and so on and so forth. So the team actually scales as the business grows. And we can see that. We can see an overview of kind of our payroll expenses here, as well as that team scaling over time. We can see breakdowns of kind of the payroll for our co-founder Bob, of how much he's getting paid when, and kind of just break down those expenses there. So really nice thing about Sturppy is that we automatically create the income statement, balance sheet, and cash flow statements. So we can pop in here to the income statement. If we want to export this to a spreadsheet, we can. We just have to click this button up here at the top, and that will export this to a nice spreadsheet format for us. Super easy to do. We could also model out a cap table. So if we wanted to kind of show what our equity looks like and kind of add future fundraising rounds, we could do that within this section. And we can add some custom KPIs out of the box for this template. We have ARPA, which is our average revenue per account. And then we also have ARPU, which is our average revenue per user. So this would be like per seat. So we have those accounts. It's going to be higher. Per seat is going to be lower. We also have an LTV, which is very nice. And burn rate, expense breakdowns, things like that. Super easy. If we wanted to extend our model out, all we have to do is change the number of months in projection. We can also change how we're looking at this data. So if we wanted to look at this annually, we can change it to annually, and now we see things in terms of years instead of months. So super easy to use. This whole home screen is also editable. We can kind of change things around, add custom KPIs here, make graphs bigger, make things smaller, however you want to customize this. And then at the end, you can export the entire thing to an Excel if you want. The whole model, you can click this button, export it, or you can share a live link, a read-only live link of your model with potential investors, mentors, things like that want to come in. They can't mess up your model, but they can view it. So if I just copy that into my browser, we can see we actually ask for a little bit of information here so that you can see who's viewing your model and when, so they can come in and kind of view that model by adding their information there. And then you can actually track who's viewed it, when, and any feedback that they might actually include in this model for you. So super helpful there. And yeah, that's pretty much it for building a seat-based SaaS company financial model. Super easy to do. You can go to Sturppy.com and click Get Started Now. You can grab that $79 lifetime deal for a founder plan. Super cheap. You can, no monthly fees associated with this. Use this tool for as long as you'd like. Build that financial model, and I hope you have a great time and good luck in growing your business. Thanks so much. Cheers.